solution. Being imaginative and creative on what sort of forum and events that are happening is always part of the British way of psyche, so that's great to see. I was in a fantastic event with the King yesterday to do with nature action at Lancaster House next to Buckingham Palace in London. Lots of dignitaries overseas, international ministers of environment, they were all there, and it's good because it's obviously attracting influencers within the global stage, and you know, London is a global hub for finance, and catalysing private capital is important in order to be sustainable for the long term. I'm sure we'll come back to that as we talk, but it really is an important aspect that one recognises governments play a role, but they are not the answer. The answer is long-term private capital being attracted into sustainable finance.
And you mentioned nature there. It'd be great to come back to that as well. But before we do, I mean, one of the big set-piece events of this week was the UK's latest industrial strategy. There's been a bit of back and forth politically about this, not just in the UK, but in other countries as well, as we sort of debate the costs and opportunities of the transition. The green finance and green energy made it into the industrial strategy. What did you think of it, and what does it mean for your investments?
It's good that it's on the agenda. It's important because there's an evolution of the recognition that nature plays a part in all sorts of economic activity. It is fundamental to over half of everything that's produced in GDP comes from nature-based solutions of some kind of services. So it's great it's on the agenda. The question that is really important is where does some of this capital come from in order to sustain the long-term, you know, nature mitigation issues, but also how we actually improve the environment and ultimately and make the world a better place. And I think the government has a role to play. I keep saying the role to play, but it isn't the answer. The answer will be from long-term sustainability. I was at you know, if you look at digital infrastructure has completely revolutionised the world over the last 25 since the TMT bubble, let's call it, of the late 90s. But it's very important, and that was private capital that was mobilised in order to do that, and then it's led to the revolution that we've had today in terms of information and the service provision, actually development of all sorts of economic growth. That's the same here. Ultimately, nature will be facilitated by the government, but it's going to be private capital that will accelerate it, develop it, and lead to that long-term sustainable economic development.
And just on that point, I mean, who pays for the transition is the real hot-button issue, isn't it? And I think in many instances we're coming to the crunch on that. But you know, the UK is trying to get the private sector, the pension system particularly, to invest more in the UK. It's got a reform agenda for the pensions sector, but also the Mansion House Accord that was signed recently, you know, pension schemes committing to invest more. What are your thoughts on that as an enterprise and the progress so far on that?
Well, the Mansion House Accord is increasingly like a demand-led. The government's trying to get the UK local government pension schemes particularly to start investing and doing things into the UK market, which is positive. I think that always mandating things is dangerous. So mandating them to invest in UK equities is dangerous. I wouldn't be a subscriber to that. Why? Because it's not free market will, and it's not necessarily the fiduciary responsibility that those that are responsible would make those choices. So if they feel compelled to do something that's against their fiduciary responsibility, that's dangerous. But I think increasingly recognising that the supply side should be looked at as well. How do we increase demand or investment in things that facilitate nature investing or sustainability investing is also just as important. And the likes Gresham House, which is where I'm chief executive of, we do a number of things. One of it is Habitat Banks, which plays into the biodiversity net gain, which is a result of property developers needing to get biodiversity credits in order to develop. And that's no government requirement in terms of capital, but it was the government facilitating supply side in terms of the requirement to have biodiversity net gain credits. And that's really made this movement along the path without government capital towards things that are beneficial to society. But importantly, private capital can get an adequate or decent return from. And I'm seeing, when I talk to investors all over the world, in the last 6 months or so, Japan or Canada, they are wanting to understand what we're doing in the UK. They're also wanting to work out how they can get access to that. So that supply side is just as important, and frankly is probably more important in the medium to long term, so that the capital gets attracted to these financial return opportunities.
Thank you. I mean, let's definitely come back to the investors, because I mean I think they're the key in a lot of this. But just on the point of the UK government has, I think you have called for targeted primary capital in areas such as clean energy and biodiversity. What's the biggest barrier? What do you mean by that, number one? And what's the biggest barrier for it to happen at scale?
So primary capital as opposed to secondary. So it's great to have ambitions in infrastructure, but when you do, if you traded secondary assets, i.e. Heathrow's been built, and whoever buys Heathrow, the actual impact upon the world, or the UK in this respect, is minimal versus let's build another Stansted airport or another runway, right? That primary capital is very different from, let's say, trading or buying an existing asset. So the real ambition should be focused on how we get primary capital into these objectives, and the scale opportunities are critical for particularly the big investors. And I think the market planning policy from the government is an important one. Again, supply side, if they can open up planning, that would allow investment in scale, whether it be in hard infrastructure, i.e. real asset infrastructure like roads and railways, all the way through to infrastructure like I mentioned the habitat banks, which is another infrastructure style asset class. Which is very much land-based. So you have this spectrum of opportunities, and the scale opportunity, it comes down to some of the barriers being removed by potentially the government as well.
Thank you. You've mentioned before that the Canadian pension model, I think a lot of people look at the Canadian pension model with envy. How possible is it that the UK could follow suit? What role can a company such as yourself play in that?
So the Canadians have obviously driven a progressive path, and I think what they've learned over that period of time, they continue to learn and they evolve their models. What they've learned is that they do need to partner with specialist managers. The ability to make investment decisions in particularly niche asset classes or specialist asset classes themselves internally is quite hard. So they need to work out if they wanted to get access to natural capital or sustainable finance, sustainable infrastructure or forestry. The ability to do that with talented investment managers in-house is a challenge, because you've got to pay market prices for the quality talent in order to make these investment decisions, and that's quite expensive. So how do you get the blend between paying the right market rates versus getting the best outcomes for your investors? So they've learned actually, and they partner with a lot of people, a lot of specialist managers, and I think that's an important learning that this country should have as they go forward on the Mansion House Accord or the consolidation within the pooling that's happening in the local government pension schemes in the UK. That partnerships, there are existing case studies of how some pools local government schemes or local authorities have benefited from partnering enormously. Some by owning investment GP stake, general partner stakes in the manager, whilst they then work for solutions in terms of getting access, deploying capital, and that combination, that alignment, has actually shown to be very good. It's something the Canadians do. It's something that there is one or two. Gresham House indeed had a local authority pension scheme as its largest investor when we were listed on the London Stock Exchange. It worked extremely well for that local authority. They made a good return on their GP or shareholder investment management investment, and they are doing okay more than in the assets they wanted to get exposure to.
Thank you. I mean, obviously the range of potential green investments is quite broad. Some of them are quite relatively mature, solar, wind power, for example. Others are a bit more nascent. What are your thoughts around the role of blended finance in scaling up some of these more nascent markets quickly? Which ones need it the most, do you think?
Well, the hard thing is when you start pooling money and capital and local government schemes, etc., is that scale, the opportunity to get scale. So when you want, say, the next Microsoft or the next Facebook or otherwise, they start very small. So sometimes that venture capital end of the arm of investment gets overlooked. So making sure that doesn't get overlooked. So the initial seed investments, early investments, and the living with seed A through to BC and then mature investments is an important evolution with investments. And I think this is where we touch on an important part that the public markets play. The private markets have obviously grown from very little over the last 20 years. If you go back 25 years, private equity had an average asset allocation of 0 within people's portfolios, institutional portfolios. It's now, depending where you are, 7 to 15, and some are much more in terms of private equity. And at the expense of public markets, which has been reduced enormously, and arguably, and you've seen the reduction in the number of companies on stock exchanges, both not just the London Stock Exchange, even the New York Stock Exchange has halved in terms of number of companies over the last 15 years or so. That's an important aspect because the use of finance and the evolution of a company can go through public, private, and then into public, and then possibly private again, then maybe public again. And that is quite an important access point for wealth managers, retail, high net worth investors, and also some institutions who can and only access public markets. So we don't want to see the demise of the public markets. We want to keep that going. And of course, it also plays into some of the private assets hands who want to move those companies on. They've held them for 5, 10, 15 years. They might want to move them along, and they want public market opportunities rather than simply passing them on to either trade buyers to get consolidated or another private equity house. It's another option for capital access and also to incentivize management to take a company on to the next leg of its journey.
Thank you. In terms of the UK Wealth Fund, do you think it's a helpful addition to this debate, or is it too little, too late? Do you think? What would you like to see it do?
No. I think it's clearly got a role, and I came back to the point I made earlier. Facilitating rather than replacing capital is what the government should be doing, and the UK Wealth Fund's purpose is to facilitate investment and then catalyse other private capital coming in. It has a very important role. The implementation, that's often a challenge, but it is an important role. I think the other aspect as part of that, though, the UK Wealth Fund does, but the government, when it gives money to the Wealth Fund, recognise it needs to take risk. So these things aren't risk-free. So you're putting too many constraints on perhaps the Wealth Fund it would lead to outcomes that they didn't want, or indeed not execution of the model they want. So the recognition across all stakeholders that you have to take risk when investing. It has a very important role that the Wealth Fund has in terms of facilitating new areas of investment, but indeed it's important that it catalyses private money. So to get that model right is not easy, but it has a very important role.
Well, just on that point, I mean, some of the, like we were talking about earlier, there were a range of potential investments. I mean, one that is getting a lot of attention is technological removal of carbon from the atmosphere. Obviously, there's lots of talk about point source capture, but there are geothermal, lots of others. What are your thoughts about some of those riskier, earlier stage technologies? Is this the sort of thing the Wealth Fund should do, that Gresham could get involved in, that your clients are seeking out?
There's a number of points there. I mean, the Wealth Fund has to work out where it sits on the risk return when it makes those investment decisions. So I wouldn't comment on that, but there will be some sensible risk return decisions that it could make and unlock private capital. But I would urge the fact that there's a lot of technologies that aren't so risky. They're already at play. Lithium-ion battery technology is a good example of that, and it's order to store energy. So and though the costs of that technology is coming down, its half-life is every 2 or 3 years, and therefore it's making it even more attractive. So the need to take more risk in things like carbon capture, where it's still debatable whether that's an economically viable model, is not necessarily needed. So I think technology exists, but so many of them are tried and tested, and we can be used today, and are in existence today, and are working today.
Thank you. I mean, I think going back to natural capital, I think Gresham's the biggest commercial forestry manager in the UK, or one of the biggest.
It's the largest, yeah. It's the 7th largest in the world.
Yeah. So it's part of that broader natural capital segment of the market, I guess, which is nascent, growing, but still at relatively low levels. What are your thoughts? What are you seeing what are you hearing from asset owners when you speak to them? Are they planning to increase, and are there any pockets of particular growth for the sector?
Yeah, it's now on the agenda. I mean, I've been, as I say, travelling the world, not just in the UK, Australia, Japan, investors, Canada, North America, continental Europe. They've all got on the agenda, how do we make financial returns as well as address the sustainability agenda? And we're seeing it come onto the radar, talked about, asset allocators talking about it, but working out how do they understand it? What is the risk returns of these assets? Forestry, planting trees as well, carbon that comes from planting of trees. What is that total risk return? And a number of investors are already well exposed, years exposure, but the Canadians are a good example of that. And therefore they're comfortable with the understanding of this asset class, and they've allocated good amounts of capital to it. You come to the UK and you've got a situation where this is a new asset class. We perceive, because as I say, we are the largest in the UK, we know it takes 3 or 4 years to educate investors in the benefits as well as the risk return. But what we're seeing after this education is now increasing the institutions, particularly in the pension funds, wanting to allocate to natural capital. We're seeing going from zero, some of our clients have gone from 0 to 4% allocations in their asset allocations over the last 12 months in natural capital. And forestry is a big part of that. Natural capital is quite broad, but forestry tends to be the biggest and largest part of that. So we're optimistic that that trend is going to go for quite a while. It's possible natural capital could grow given its scale and its impact in economic GDP. We think that 4 could grow to a much larger number, and then on top of that we'll have the other parts of the world, continental Europe, Australia and Japan's already allocating to it. Indeed, we've publicly now had a Japanese investor into the UK forestry in the last month. So we're very optimistic that asset allocation will grow, a bit like in private equity 20 years ago, 0. Now it's at 7, 15, depending on who you are, and we think that 4 could go even higher. So we're very positive about that. We think that the returns at lower risk, because of the volatility is relatively low in these areas compared to maybe equities, for example. So the risk return is actually, you're getting a supernormal risk return opportunity for investors.
You mentioned the allocation potentially increasing. Is there a natural ceiling for the natural capital asset class, and how are investors bucketing it? Are they just putting it in real assets? Is it in infra?
Yeah, it's a good question. All right, it's a good question. So is there a ceiling? There will be. I mean, it depends on how you can institutionalize. But if you look around you, everything that's outside of the building is natural capital. So it could be unlimited and effectively, but it will be limited, because what can be institutionalized and invested in by an institution will be capped at some stage, a bit like private assets and private equity. I mean, I think the growth in this aspect is considerable. So if you ask that question again, if you think that these, could you just ask that again, Simon?
I was just curious about how, conceptually, how much could people allocate to natural capital?
Well,
if it's at 4% now, for example.
I mean, it could go significantly higher. As I say, you know, the market for forestry is opening up. Australia hasn't started to allocate fully to natural capital. Canada's still got more to allocate to European natural capital. So there's a lot more to be done. And I think as allocators begin to realise that they have zero allocation today, that they do have scope to do that, and that risk return opportunity remains a positive one. Coming to your second point, I've remembered now, was around where does it fit, infrastructure versus and this is something that we've debated with allocated investors all over, particularly in Australia, where the way that they value their benchmarks it actually put forestry into infrastructure, which we didn't think was appropriate because of the various risk return attributes that do come out of forestry, which meant there was also an under allocation as a result of that benchmark. We perceive it has more characteristics in favour in terms of property related investments. There's significant inflation linkage, natural inflation linkage. And we think that if you look at some property investment allocations in institutional portfolios, you know, there's a significant amount to go from 0 to a 4, 5, 6, 7. And so we're very positive that asset allocators actually over time will probably look at this as an independent asset class, although the characteristics do look a bit more like infrastructure and or property. We think they'll look at it as an independent asset class over time.
And is there any country that's really leading the way on this, where the investors just really get it?
Yeah, I mean, and when you go to the Canadian Maple 8, you don't have to spend too long. They go into the depth of sophistication in terms of their knowledge of natural capital, regenerative agriculture, nature-based solutions, forestry, planting carbon. They're up the curve significantly.
And you touched on this earlier with the biodiversity net gain, which is a UK government initiative, isn't it, to require a biodiversity net gain if you want to build anything. More about that, but also at a slightly broader level, the different revenue streams that you can get off natural capital. I'm thinking carbon credits. How important are they, for example, to the development of the asset class?
Yeah, the market, again, back to the supply side, the government having a standard metric, in this case DEFRA for the habitat banks, is critical to get confidence in this as an asset class. And therefore, these credits are then required by property developers. Property developers need to go out to the market and buy these to offset their biodiversity loss within developments. And so that whole market is stable because people feel confident in it. So having that as a basis, a benchmark for things like carbon, which still there isn't a benchmark that's generally accepted, is critical in order to scale this aspect. And I think, you know, we're expecting to deploy up to 100 million sterling into these habitat banks over time, and that is something that could be and should be looked at as a model for government not having to spend money, just have to make sure stable policy, the right benchmarking metrics that are consistent to lead it to a robust investment mandate and class.
Thank you. I mean, just going to the credits for a second, carbon and biodiversity credits. the voluntary carbon markets, the voluntary credits, the market's still forming, the plumbing's still not there completely. The trust from corporate buyers isn't necessarily where policymakers would like it to be. What are your thoughts around that, and how important it is that that problem is fixed before this asset class can really take off?
It needs to be fixed. Yeah, you need a standard benchmark, and then people will gravitate towards it as being the acceptable tradable currency for credits. If you want credits to be something of positive use, you need it to be generally accepted and valued the same by everybody who trades it or invests in it. And whilst you have these different benchmarks, and indeed are some of them real when you go to some of the emerging markets, do they exist? Then that's a difficult thing for an investor then to get their head around, because they don't want to take that risk.
I mean, one of the things that's one of the big events this year will be the COP30 climate conference in Brazil in November. Countries are being asked to come forward with new NDCs, new climate action plans, basically. How are you going to get to net zero with specificity? When we talk about the regulations and the plumbing, what would you like to see? Not just credits, but generally, what would you like to see as an investor from countries? What level of detail is important for you to help you have confidence in investing in a country?
Policy and stability, so cross-party support for whatever policy is relevant. And we had that for the Environment Act that then led to the biodiversity net gain. That it's exceptionally important, so that there's no changes when the government changes in a jurisdiction, that then you think that there's going to be a change of policy. So general buy and cross-party support across geographies is critical in order to be able to robustly plan for the long term, and institutional investors to be able to do that. So that would be the priority one, I would say.
Great, thank you. You've just closed a Forest Fund 6, I believe. Could you talk a bit more about your plans for that? But also, when we talk about credits, how are you going to ensure transparency in how the carbon and biodiversity credits are generated and monetized?
Yeah. So I'll start that last bit. We've been working in forests and managing them and investing in them for over 30 years, the teams and at Gresham House. And so we have the mechanics, the processes, the robust ways of modelling these types of, and recently carbon. So we're at the forefront of that and talk to the likes of DEFRA and so on. So we feel very confident that we're almost a go-to party in order to get that. As far as the allocation goes, we see the opportunity in UK forestry, both secondary, i.e. the sales of existing forests, but also planting, also the carbon that comes off that planting. And I think that we're very optimistic that policy is beginning to recognise that the benefits of planting trees, not just from a carbon angle and from the fact that you can make decent financial returns, but the necessity is for the security of the country, for house building, for example, and jobs. And if you have a look, we are an 80% importer of trees into the UK, 80. And if you think half of the wood goes into building houses, you can suddenly see the importance of keeping the volume of trees growing in this country in order to sustain house building, which we know has of the order of 200, 300,000 houses a year required in order to get to where they want to get to, this government and previous government. So it's a really important part of the fabric of this country in order to achieve the housing supply-demand issues. And therefore, supporting new planting, supporting commercial forestry is a critical aspect in order to have social goals, housing goals, employment goals, and then ultimately economic growth goals.
Thank you. I mean, one of the big sort of points of tension in the forestry system, I guess, is when companies just plant monocultures. How problematic is that? How do you respond to that sort of criticism, not to you personally, but to the system? How do you deal with that? And I guess connected to that, going back to the investors, how open are they to seeing the economic value that comes back to them being diverse? So not just the sale of the trees to build things, but I don't know, rural jobs, for example.
That's precisely. So a big part of our lives are education, educating the whole story, not just the simple story of what you call monoculture. But the monoculture is pretty rare. I mean, whenever we do plant trees, we also have to expose ourselves to broadleaves, indigenous trees as well. So typically 20% is or more is local or indigenous trees. So there's always new and broader than simply a monoculture. So that would be a wrong representation of things. But the important bit is that education, that it does bring rural jobs. It does bring the ability for social benefits and housing benefits and employment benefits and all of and ultimately, of course, the carbon decarbonisation agenda. So educating that whole story is an important aspect, and we think we're doing a good job. But you can never make everybody happy, because there's people do have different views on things. But I think all in all, it's clear that we're making a good case to local governments and local representatives that this is net beneficial to local communities as well.
Great, thank you. The Climate Change Committee, which is the independent group advising the government on its sort of climate trajectory, were out this week. I said we're on course for net zero, but they had some pretty big caveats there, as long as policy reform continues. But just on natural capital, one of the points they've made before is that, well, they've set ambitious woodland targets for Scotland. What's your role in meeting those goals, and what policy support would you like to see to help you?
Well, we will be integrally involved in consultation with the governments and local authorities who kind of implement those types of planting of trees, and I think that's an important one, because coming back to, we've got to make sure communities are bought into this, and we need planning support in order to turn what typically is unproductive land or agricultural land into things that are productive. And that is, again, it's a very patient consultation, and it's one which we're used to. We're used to educating and patient consultations. So I think we have a lot of data to support how this is net beneficial to the environment, the communities and investors, in order to get through that.
Great, thank you. I mean, the Climate Change Committee did say one of the priority recommendations was to lower the cost of electricity for consumers. I just wondered, and you yourself have mentioned that grid infrastructure in the UK is one of the bottlenecks. I just wondered what your thoughts were about how to fix that, and what role does GB Energy have in that, do you think, in terms of de-risking investments?
Well, the point you made earlier, technology. Technology exists to manage the grid better today, and we're now at 30 to 40% renewables. We've had a day recently where it was 100% renewables to electricity generation. So the ability to do that exists today with the technology today, and the costs are coming down today. So the requirements to invest in maybe a riskier technology to achieve the goals, you kind of think, well, why? Because we're already potentially doing it today. Where there are legacy systems or operational infrastructure, that is some of the bottlenecks that you refer to. What they call in battery energy storage is often skip rates are too high, i.e. skipping using batteries and preferring to use gas in order to manage the balancing mechanism in the UK electricity, is something we think is not beneficial to the environmental needs of society, and indeed, more importantly, cost. And the moving towards accepting that battery energy storage is a solution for renewables to get from 30-40% to 80-90% would be a very big development for this country.
How long do you think it would take to get to that 80 to 90%?
Well, in 7 years, we expect the projection to get around 35 gigawatts of energy, of battery storage capacity, which is equivalent to where the gas capacity is today available. So you could say within 5 to 7 years, you should be in a place where you can actually just use battery energy storage entirely.
And in terms of the grid connectivity, when you look across the planet, is anyone doing a good job? And it feels like it's an issue that touches lots of countries, particularly developed countries. What are your thoughts on that?
When you say a good job, cheaper electricity or more renewables usage?
I think just successfully getting the solar panels connected, for example, to the grid.
So, I mean, look, the UK has done very well. All right, it's solar, wind. We've gone from 15 plus years ago, 20 odd years ago, to 30, 40, 50% now, right? In terms of, so we've obviously done something in the UK pretty well. Continental Europe is not far behind in all of that, so that's in a good place. And the usage of technology of solar and wind is now, people don't even consider it as being a risk in terms of its technology. So I think the globe is in a good place, and the issues is how do you manage that? You know, the electric system in the UK, the grid is still challenged, and we can see that in some of the pricing. We are in the UK. Pricing of electricity is 2 to 3 times elsewhere in continental Europe, and certainly in America, where it's at least 3 or 4 times more expensive. And so there are benefits that we are not capturing yet in the UK.
And you mentioned, we talked about battery storage a bit, but when you look across all of the different technologies that are evolving in the battery storage space, how diverse is it? How optimistic are you about the quality that you're seeing and the pace of change there?
In battery storage?
In battery storage, yeah.
Well, again, if you stick with lithium-ion technology, which is tried, tested, works, and is coming down in price, there is clearly an acceptance that you don't have to take too much risk because of that, those case studies and precedents. So I think the globe is in a good place. Of course, the issues are supply chains and such like for lithium-ion, but there's no suggestion that is a constraint on that growth. I think the globe is in a good place to use energy storage alongside tested technology like wind, like solar, in order to evolve into the new energy world that is inevitable, is coming.
Thank you. And just lastly on sort of the energy transition, I think you previously called for zonal pricing of UK electricity. Why is that, and how feasible is it, do you think?
I think it's a debate. It's not a black and white answer, but we think that there would be at the margin some improvements in pricing within local communities if you end up, or regions if you end up with zonal pricing. But I think it's definitely not a slam dunk on that debate, and it's very clear when you look at the debate and read about it that this could rumble on for quite a while.
Thank you. So moving away just to the company, Gresham House, it's obviously got strong roots in the UK, but you're increasingly branching out internationally. What is the strategy for the next sort of year, 2 years on that score, and which countries look attractive to you at the moment, and why?
So we're an alternative manager which is quite niche in terms of some of the growing areas of asset allocation. Natural capital, we talked about energy transition and infrastructure are the key areas, but also growth capital like venture capital. We're the second largest venture capital trust investor in the UK. So we're very optimistic that those areas of asset allocation are not just growing within investors, LP investors, but also a necessity for economic growth and the sustainability agenda. Where do we see a lot of that growth? Well, the UK is growing. We mentioned earlier that there are clients in the UK going from 0 to 4% asset allocation in natural capital. That is beginning to happen around the world. Whilst Canada is an example where they're ahead of the curve and already allocating for a number of years to natural capital, they're now beginning to look elsewhere across the globe. They would have looked at North America being, on Australia and New Zealand being areas typically historically to invest. Europe is increasingly on their agenda, and it's very evident that they like the legal systems in Europe. They like the investment processes there, and so I think we'll see over the next couple of years more capital coming from North America, Canada particularly, to do that. And then similarly, when you look to Japan and Australasia, this is well and truly up the agenda in Japan. They're already allocating. I mentioned earlier we have a client now recently from Japan that started after 2 years talking in Japan to clients. And I can see when I've been in Australia to asset allocators, it is on the agenda. It will move up the agenda to allocations over the next couple of years would be my expectation. Some are already doing it directly, but typically in their local region of Australia and New Zealand. So I think it's a very exciting time. I mean, it's incredible if we end up with that, as I mentioned earlier, an independent asset class in a few years' time called natural capital, which is what I expect. It'll be a bit like how much do you allocate to private equity, infrastructure, and how much have you got in natural capital. It'll be a standard discussion topic.
Great. You mentioned North America there. Can we talk about the US specifically? Obviously, it's the big story of the year in so many ways, and it will be for the next couple of years, I'm sure. But in terms of the US, lots of policy decisions by the Trump administration on all things green, in many cases a pullback. How has that impacted your strategy and view of market development there and globally?
What we're seeing is LP investors wanted to come to Europe and talk about it a bit more. That's absolute for sure, both infrastructure, energy transition, and also natural capital. So it's getting people's heads up, and that's applying. I think elsewhere across the globe, Asia thinking they should they invest in Europe more than they did previously, where they would have gone to North America. That is definite. Talking to LPs globally in the last 6 months, no question. That's going to benefit those people who have good platforms in Europe or market shares. Gresham House is one of those, and we are aiming to capture that, and hence by building relationships, partnerships with these large LP investors, allocators around the world. And so it's mean that we've had to get up and get out of our seat and go and meet these guys and tell them the great story that people like Gresham House has to capture the energy transition, the natural capital, all the infrastructure opportunities in the UK and Europe.
And I remember when the Inflation Reduction Act, came in, all the credits that the Biden administration gave out. A lot of it was a joke, almost like there were wind turbines ready to be put up in France, for example. They're put on a ship and taken to the East Coast. Is that flow reversing? Is it actually a thing? Are you seeing money move already? Because
yeah, we are definitely seeing. I mean, money doesn't just overnight, particularly long-term 10, 20-year money doesn't go within a week from I was here and I'm there. But the mere fact that these dialogues are happening, the mere fact that relationships are being built and partnerships and framing of partnerships is happening, it will mean the probability that capital starts coming here over the next 6, 12, 24 months is a high probability.
Thank you. And just, any money that does come over here, it is coming to a region where policies have also been rolled back a bit, even in the European context. Various green initiatives have been just pulled back a touch just to maintain competitiveness, is the argument. Are you still confident that Europe is a leader in that regard? Are you expecting an even bigger pullback, or are you confident that we've sort of bottomed out a little bit there?
Capital will go to where financial returns are. If the financial returns are good and attractive with stable environments, they will continue to go there, regardless of any other agenda. So the mere fact that you have additionality, as well as the financial returns, will attract capital. So I'm very confident, if you look at some of the returns we've made in the last 15 years in the UK forestry, for example, have been 11% plus per annum. Now, that's an attractive return based on a low volatility or low risk basis. Now, not necessarily that's what's going to be going forward, but there'll be significant returns going forward. And if people understand that, the additionality will be an additional component, but the financial returns will always be primary. So I'm very confident, as long as you can put decent asset classes with additionality, with primarily good financial returns, the capital will flow.
Great, thank you. Moving away from organic growth strategy for a second, a lot of flux in the asset management industry more broadly. What are your thoughts around consolidation? Is Gresham House a potential buyer at the moment?
Well, so a bit of a recap. Gresham House, we bought into in 2014. It was effectively a shell company on the London Stock Exchange, and we got it regulated, turned it into an alternative asset manager, and we went on an organic growth and an acquisition growth path. We built a business which had some very strong global and regional market shares in energy, infrastructure, venture capital, natural capital. We were then approached about 2 years ago to go private, and when the board eventually gave shareholders a fair return and price, we went private and backed by a private equity house. But the aim of that was to continue our journey in internationalizing the business, which includes acquisitions and inorganic growth. A very clear path of organic growth, but the consolidation within alternatives was going to continue. Those let's call them mid-market alternative houses who can't push on the regional or global stage, want more distribution, can get some synergies out of business development. That's what we do. We've done it well for over 10 years. We've got a phenomenal team and teams within our business, amazing team players with ambition and capability. And so you should expect us to partake in inorganic or acquisition growth, and you should expect us to develop internationally as part of that.
Is there any sort of rough framing around that? Is there a sort of a certain size of company that you would consider, and are there any geographies that look particularly interesting just because of maybe the number of houses or the pricing?
So the thing the starting point is, how do we add value to a business, and then we'll pay accordingly. So if we found a large acquisition, we'd be able to fund that, in my opinion. As long as it made the return that we need from it in terms of return on capital, but also importantly, part of that will be how do we develop it? How do we grow its top line? How do we grow its assets under management? So that business development plan is critical to any analysis and investment. We've taken, if you look in history, you've taken businesses where we bought for only £2 or £3 million, and we've turned them into the largest, battery storage producer in Europe, or asset manager in Europe, with over $1 billion worth of assets under management. So the point being is, it's about where you see vision to create economic growth, backing capable people. So everything from 2 million up to several hundred million is in my mind in terms of what we could buy. But I have a very capable team around me to keep my feet on the ground and make sure we go through the right process and that we can add value.
Great, thank you. You mentioned about the management buy-in and being taken private. Just in terms of the buy-in and the journey, like how risky was all of that? And is there anything you, in hindsight, would have done differently?
It's definitely risky, and my whole life since sort of leaving university and joining the city is you're meant to take appropriate risk returns. You get educated and taught to do that, and you learn from mistakes. So it was risky when we bought it in 2014. There wasn't anything there. It was just a vision with persuading people that we were going to execute. We did. We executed very well, made a fantastic return for people who lived that journey for about 8 or 9 years. And now we're doing it again with a number of different shareholders. And importantly, we, the management team and employees, own a lot more of the company now than we did when we were on the stock exchange. So we're really proud of what we've got. It was a risk, it's paying off, but everything you do needs to be risky in order to push the boundaries and grow economically anywhere and anything.
Thank you. And you mentioned the PE ownership. How have you found it? First full year chalked up last year. How have you found private equity ownership, and what are the sort of the pros and cons of not being in the public eye?
I've really enjoyed it. I mean, it is different. I'm a big advocate of public markets. Come back to that if we need to, but they have helped us laser-like focus on a 5-7 year plans. You can think about things over the long term without necessarily a daily desire for shareholders to tell us what you're doing. And they have a different perspective, a diverse perspective in many respects that leads us to achieving a value growth plan.
Great. And earlier in your career, you had a variety of roles, including at SVG Investment Managers, Phillips & Drew Fund Management, and the LPFA. You've also played rugby at a high level. So how would you say these various experiences have shaped you as an investor and a manager?
Well, it makes you competitive. Sport particularly makes you competitive. Being in the city is very competitive. It's the top talent that comes to the city in order to achieve financial goals, typically. Being in sport, setting goals and getting yourself off the ground when you fail is a massive learning experience, and that happens in the city. Working and enjoying the wins is fantastic, and the celebration, like sport, when you enjoy the wins within a city environment, is fantastic. So I would say I've learned a lot through sport that's allowed me to get off the floor when we make mistakes and learn from them, go forward and go again.
Great, thank you. We're coming up to the end of time, but we've got a couple of last questions if we can get through them. Where do you see the most underappreciated investment opportunities right now, either in the UK or globally?
I'm a contrarian, which means when everybody else is running towards something or away from something, then I like to have a look at where they're running away from. And at the moment, we see the London Stock Exchange is under what, inverted commas, a cloud of people thinking it's not very good for whatever reason. I think that means it will have many opportunities with it that are undervalued because of the dislocation of valuation. So I think that is something that people should focus on. And they genuinely are, particularly in the smaller company areas.
Great. And just very lastly, if you could change one thing about the UK investment landscape tomorrow, what would it be?
The corporation tax rate. If you made domiciled and stock exchange listed companies pay 15%, say, on their corporation tax rate, you would see an enormous attraction and then ultimately an increase in liquidity within the London Stock Exchange, which is a massive goal. If you look in Ireland they lowered 15 odd years ago their corporate rates to 12.5. You'd have thought their corporation tax revenue went down. It didn't. It went up from 4 billion to 22 billion over 10 years. So the benefits to this UK could be enormous, both from the London Stock Exchange, but also from the government's revenues.
Great, Tony. I'm afraid that's all we've got time for. Thanks ever so much for joining us today.
It's a pleasure. I've enjoyed it. Thank you.
Thank you.